Welcome back, everyone. And we could have another great episode in particular area of real estate investing, which hopefully all of you will find great value. Welcome back. This is Win Yi, and my co-host is Julie. Good morning,
Hi, good
Julie.
morning, Wing. How are you?
Very good. Fine. Thank you. So without further ado, let's dive in. We are going to talk about something very interesting. And let me share my screen first and foremost. And so the headline for our topic, our podcast is, should you retire? For those of you who are age 60 or above, this is important. Then on the second half of our module, we're going to talk about, for those of you who are not about to retire anytime soon, maybe you are age 40, age 45, you have 10, 15, 20 years before the traditional retirement. So you have to determine, we can share with you what kind of retirement plans, what kind of exit strategies you can draw on your IRAs, 401k, and all those tax qualified plans. Right. But you could be very surprised of how we can do this. Okay. We are not presenting a traditional podcast about retirement. We can share with you and we can help you think outside the box. Yeah. You have to get out of your comfort zone. There's another alternative way you could fund your retirement, still with the traditional IRA tax qualified plans, but with different investment strategies instead of the typical brainwashing Wall Street stock market craps.
Right, there you go.
Okay, Julie, I think Julie know what I'm talking about. So yeah, retire with traditional tax qualified plan using your IRA inside a hard asset. Okay, physical hard assets. So let's dive deeper, and you will be very surprised. So normally for decades, Wall Street and the traditional financial retirement planning, once you're ready to retire, you typically, correct me if I'm wrong, Julie. Okay, you understand this kind of retirement plan is
Right.
based on your background as well. So the traditional financial planners, they recommend 5% withdrawal from the retirement plan. All right, 5%, because you need to be conservative. You need to withdraw your money so you can outlive your money instead of money outliving you.
Exactly.
Yeah. Wall Street, they're very strict about this kind of compliance procedures. So anyway, here's a case study. Okay, option number one. You people listening out there, you are at this particular age, 60, 65, or even older, and you have approximately $1 million in qualified plans. What are they? They all could be a combination of 401k, IRA, solo 401k, etc., where all on top ago, you did a pre-tax or after-tax contribution into a tax qualified plan into this type of vehicles. And then the money will grow tax deferred over time. And then at age 59 and a half or older, you take a monthly taxable withdrawal. For the most part, taxable withdrawal. When you withdraw the money at retirement, you still have to pay ordinary tax.
Correct.
A lot of people may not know, with certain exceptions, such as Roth IRA, where you can do a tax-free withdrawal. Those are
Correct.
exceptions. Okay, so far so good, Julie.
So, all right, that sounds good. Yes.
Again, 5% withdrawal rate is very conservative because you can't risk your money during retirement. So that's how Wall Street does it, right? That's how they've been doing it for decades and generations. That's how it is. And
Right.
with that said, the way traditional retirement plan are done by Wall Street and your broker, your reinvestment broker or retirement planner or your CPA or your CFP, certified financial planner, whatever designation you guys out there, whatever you're working with, they run the numbers for you, right? When you're approaching retirement, do the 5%.
Right.
So given the retiree's age and risk tolerance, the financial advisor under SEC, Securities and Exchange Commission's prudent rule, you wisely rebalance your client's portfolio into a asset allocation into some mutual funds. Inside the mutual funds, consists of 30% bonds, 20% treasuries, 25% money market, and 25% CDs, right? Low risk, 5% withdrawal rate. The idea is that $1 million you have, you can preserve the principal throughout your lifetime, right? To one's lifetime, never to run out of money. Preserve the principal. That's why, hence the 5% monthly withdrawal rate in age, age 59 and a half or older. Okay? Okay. Yeah, again, the purpose is not to run out of money during a retiree's life expectancy, and the preservation of principal is critical, taking into consideration inflation increases. That's why this is a traditional methodology. Yeah, Julie, let's crunch the numbers. $1 million, some people think, oh, that's a lot of money. No, a lot of surveys, a lot of consumer surveys are conducted. A lot of people, they don't even feel comfortable with $1 million of retirement. Some people say 2 million, at least 2 million. Most people feel more comfortable in retirement as opposed to 1 million. Well, so
that makes sense. Yeah.
We heard that, but 1 million is a good threshold, is a good starting point for most people. So if anyone can reach that level, hey, kudos to you. Anyway, so Julie, okay, let's do the 5% withdrawal rule. 5% multiply 1 million. Yes, just do the simple basic math. Misspell, sorry. Equals $50,000 per. I just did this PowerPoint yesterday.
Oh, okay. Good job. Good job.
Chart to edit, so I was in a hurry.
I understand.
Equal $50,000 withdrawal, right? Simple math for a year. Okay, divided by 12 months. So therefore, to give or take, $4,000 of monthly taxable withdrawal. So far, so good based on the normal.
That totally makes sense.
$4,000 of monthly withdrawal taxable, most people. At the ordinary taxation now, some people at retirement, their taxes are lower bracket. We cannot assume that. Some people have a higher ordinary tax bracket, 20, 30, even 40% ordinary tax bracket at retirement. You can't assume just because you're reaching age 60 or above, your tax bracket is drastically reduced, right?
That's true.
Years ago, you may be able to assume that, but today's age, a lot of people are making a lot of money from different retirement sources, not just one source. $4,000, you take away taxes, maybe $80,000 monthly.
Yeah.
I don't know. I live in San Francisco Bay Area.
I don't think you can live on that.
$3,000 to $4,000 per month retirement. That's right. To brag about.
No, it's not. I know. That's not enough.
Oh, not enough. But anyway, we're just trying to prove a point. That's all. Okay. All right. Let me, we can see. So now here's the kicker. Okay. A lot of people don't know that. And the traditional Wall Street financial advisors, they don't want you to tell you that. They want to keep you in the dark because they want to get paid 1% management fee to keep your portfolio in the traditional stock market and mutual funds. They don't want you to think outside the box. Julie, you're on Wall Street been brainwashing investors for the longest time.
Right.
That's how they made the money. If they allow those brokers money.
And the interesting thing is too, they'll take that 1% or 1.5% or whatever they charge you annually, whether you make a profit or not, they're still going to take their share. So not always in your best interest, always in their best interest, but not always in your best interest.
Exactly. Okay. Okay. Anyway, we proved our point. So let me give you option number 2, and this is not so bad. Okay. Option number 2, the one perhaps you and I recommend, is to roll that very same $1 million from your various brokerage accounts into a self-directed IRA. Now, let's pause for a moment. Some people say, oh, some investors thinking, I already have a self-directed IRA. I have it with Schwab or Fidelity. So what's wrong with that answer, Julie?
First of all, Schwab and Fidelity are not going to be able to hold a self-directed IRA because there's a special trustee that has to hold a self-directed IRA. No, most people will not even understand what a self-directed IRA is unless they've done something like this. Yeah.
the brokerage, I hate to pick on Charles Schwab, but there are other players that
Oh, absolutely.
they do say, oh, we do have self-directed IRA within our in-house mutual funds. Yeah, you could self-directed bonds and money market, self-directed within our portfolio within Charles Schwab into another self-directed mutual funds within our in-house account, right?
Yes.
Again, it's a very misleading statement. A real definition of self-directed IRA is you roll the money over, transfer over from a traditional IRA. Real self-directed IRA, a custodian, a trustee, where you can use those money to buy alternative asset, still within the tax qualified plan, still continue to get the tax deferral and tax-free, whatever situation, right?
Right. Absolutely. Right.
In essence, when you roll a traditional IRA into a self-directed IRA, the tax law hasn't changed. You still get all the great tax benefit. You the paperwork shuffle. Think about it. It's a paperwork shuffle. You did it. In fact, let's spend 2 minutes. You're the perfect person to talk about this. You yourself, you and your husband, 3.5 years ago, you guys rolled over several of your traditional IRA into a self-directed IRA custodian to buy rental property, to buy family home, duplex, whatever in Buffalo, Niagara Falls, New York. So tell me a little bit about how you able to accomplish that.
It was a simple process getting the funds from our traditional IRA into a self-directed IRA. And I think most people, if you've ever left a job and rolled your old 401k or your old 401k into a traditional IRA, it's the same process. Basically, it's the exact same process. So it's not rocket science. It doesn't take all this complicated stuff. It was a very simple process to get it over there. Then once it was over there, we were able to utilize those funds to purchase properties within each, my husband and myself, into our IRAs. So it's no different really than just moving it from, say, like you said, Charles Schwab to maybe JP Chase Morgan or something. It's the same process. So it's not hard at all. And I think most people, if you've been in the workforce for a number of years, you've done it at least once.
That's right. Not only that, we're not going to get into it, but your rental properties, your physical asset, your single family home and duplex that you purchased in Niagara Falls has achieved double-digit returns in the past 3.5 years.
Absolutely.
Much higher return than the traditional mutual funds inside IRA. Am I right or wrong?
Absolutely. No, you're absolutely right. 100%. And again, I think if people begin to understand the concept of or the value of taking a piece of property and putting it inside of your IRA, there's so many benefits on ways that you will get, where the account can increase in value. It's not just the rent that you're getting, but it's also the appreciation on the property as well. But I know that's another subject for another time. They'll have to watch one of our other videos to understand about that.
Absolutely. Yeah. We have done other tax videos recently. And by the way, when people roll over their previous employers' 401k, previous brokerage houses, the IRA, the sub IRA, solo 401k, is a tax-free transfer. There are no penalty. You pay for transfer processing fee of few dollars.
Exactly. No, you're absolutely right.
Be careful when you guys do that. Your financial planner that managing those portfolio, they're gonna discourage you to doing this. Obviously, we discussed about that, right?
Our broker was not happy when we left and was trying to talk us into doing something else, but we had already decided what we were going to do. And what I said earlier about how they take that 1%, that was one of the motivating factors for us to leave, because when the market started to go sideways a number of years ago, he didn't make any moves. So we're like, okay, why are we paying you this 1.5% and you're not doing what we're asking you to do? It would really make sense for us to do what we did and put the properties inside of the self-directed IRAs.
One important thing I want to say, Julie, that when you are at the mercy of a mutual fund company, you have no control. You are totally passive, right? As an investor.
Absolutely.
You have no control. You are at the mercy of the mutual fund manager.
Absolutely right.
Who may take higher risk, who could churn your accounts, who could divert your portfolio into some risky investment. You can use
absolutely.
And like we said, if your account balance lose money, guess what? Those mutual fund managers, they still get paid 1 to 1.5% or even more. And whatever left over, if you as an investor, after you paying processing fee, administrative fees, and all those fees inside mutual fund, you get the crumbs. You get the crumbs remaining.
Yeah, no, you're right. I just remember I think this particular broker, we left it with him for like 3 years. And at the end of the 3 years, we hadn't made any money, like anybody. That was very disappointing. So it was a refreshing change to be able to do what we were able to do with the properties.
Exactly. Now, speaking of control, Julie, you and I discussed that many times. When you invest in real estate, when you buy rental properties, you are in direct control because you buy under your name, or if not under your name on a traditional, conventional loan under your name, you can buy in the name of the IRA.
Absolutely.
The IRA belongs to you, really, but technically speaking, IRA is a separate entity. But
yes,
you still control it. You control the self-directed IRA, where the money is going to go, what property you're going to buy. When you buy the underlying income property inside the self-directed IRA, you see is the for the benefit of the name of the IRA, you can control where you buy, what kind of tenant you can accept, what market to buy, what kind of property you're going to buy, what's the best market. You have direct control, you and the IRA.
Absolutely, 100%.
So with that said, Julie, I'm going to use this example for today's presentation. At $1 million, right? Roll it over into a self-directed IRA. Of course, I will show you the custodian you can use. You could buy potentially 2 income property, a hard asset, 2 fourplexes. Okay.
Wow.
Okay. Just bear with me. Okay. I know where we're heading, but most people
absolutely
watching don't know, have no clue what I'm about to present. Okay. You do, because you have personal experience. You and hundreds of my real estate investors over the years, I have guided them to take money out of the traditional IRA to buy income property for assets in the best location in the country using this methodology that I'm teaching everybody. Am I right or wrong?
Oh, no, you're absolutely right. 100%.
So even though I'm a real estate consultant, even though I'm a real estate broker, I understand how to use income property inside the IRA and help people to earn a higher return with even potentially lower risk than the stock market IRA. Am I right or wrong?
Right. You're absolutely right.
I love this. So buy 2 duplexes with the $1 million. All right, here we go. Here are the numbers, okay? And I'm just picking the market. There are many other locations that are very good to buy, many housing markets, but I happen to choose this particular housing market in Texas, okay? And this is a new construction. 1 fourplex is only $539K, which is amazing value. And I'm not going to go over the numbers too much, okay? So at the end of the day, I mean, you buy $539 of your self-directed IRA in the name of the IRA to buy this property, okay? This is the actual amount you put it in, or cash, right? Or IRA, you minus the closing cost, whatever. Then, of course, the monthly rent for all 4 units is like this. Again, I'll go over, I'm not going to go over the taxes, insurance, property management fee. They're all down here. I don't have room to discuss it. But at the end of the day, this purchase will net you monthly after you pay the expenses in the IRA around a little bit more than $3,000.
Wow.
Okay, half $500,000 of our purchase getting $3,000. So remember the earlier example, the 5% withdrawal.
Right.
So 5% withdrawal, you're getting about $48,000 per year and around $4,000 per month. Half of the money to buy this fourplex already almost exceeded your $1 million purchase of the withdrawal rate, and $1 million withdrawal rate at monthly at 5% withdrawal rate, right? So
exactly. Yes.
like that, $3,000 of monthly net cash flow inside the IRA, inside the IRA. This money, you could withdraw it, because if you're over 59 and a half, You can withdraw money without any 10% early withdrawal penalty, nothing like that. So we can withdraw this money from this one purchase, but we're doing two purchases because you have $1 million, right?
Mm-hmm. Correct. No, that's
Now,
right.
you can buy two of these,
Right.
fourplexes. Do the math. Two of
Yep.
these, seven fourplexes multiplied by two, 3,119 monthly net cash flow on your passive income multiplied by two equals what?
62, something like that.
Yeah,
62. Yeah.
6,000. For the sake of discussion, let's say 6,000.
Okay.
$6,000 instead of 4,000.
Okay. 4,000 originally. Yeah.
We're
Mhm.
talking like 50% higher return. Oh, speaking of
Right.
return, this is a pure return, 12%, right?
Wow.
You're getting
Wow.
12% consistent return just for this year. When the
Right.
rent increase, when and if the rent increase 3 to 5% every year, you
Right.
can get more cash flow, more
Right.
money to spend on to whatever the rental rates increase. Plus, they're probably gonna appreciate 3 to 5%, hopefully on use this, but you're not gonna take advantage of the equity growth because because you're not selling the property because
Mhm.
you're withdrawing this income for retirement, right?
Mhm.
So,
That makes sense.
so for the time being, don't worry about the equity growth, which you will get on like in any other properties. If you
Right.
invest for the long term, you will get appreciation, equity growth, and all that stuff, right?
Absolutely. 100%. Yeah. That's a great example. And I think the point that you made about the rental income will increase over time. Whereas that with the original example of taking just the cash amount, that's not going to increase. And then, like you said, you have to hope that your money doesn't run out before you do. So where
Right.
in this case, this will go on into perpetuity. You could pass that on to your grandkids or whatever. Yeah.
Absolutely. Absolutely. Look, monthly 3,100. Okay. Uh,
Mhm.
annually almost 40,000. So
Mhm.
$40,000 annual net cash flow divided by your initial investment of 550K equal 12% annual monthly yield on a retirement portfolio, which you have a low risk tolerance, consists of bonds, CDs, and money market. On the example I just alluded to earlier, right? From
Right.
our
Right.
conversation, you normally get 3 to 5% return because you want to be conservative every time on these mutual funds.
Mhm. Absolutely.
So
Absolutely.
we do an apple to apple comparison, or you can go do the traditional investment route, what the Wall Street will recommend for you at retirement.
Right.
With a 3 to 5% return on your conservative portfolio,
Mhm.
or 12% return at the minimum. It'll go higher as the years go by during the retirement. Make sense?
Absolutely. That makes sense. I think that makes sense to anybody. It's simple. It's simple math.
Very simple math. We're talking apple to apple comparison. It's all ninth grade math.
There you go. Hmm. Yeah.
Yeah. All right, let's go on. Okay. Anyway, so you buy two four-packs, $1 million, and
Mhm.
12% return, like I said. But yeah, we just discussed that. Okay. We just
Right.
discussed that. All right.
But it's nice to see it. Now you can see the side by side comparison.
Absolutely. And of course, we have self-directed IRA custodians that are true self-directed IRA custodians that will help you buy the real estate. And when the money's inside on this, your income property, income and expenses are inside the IRA, inside the trustee, that is, right? They are in compliance. They are processing your record keeping and everything else. We just talk about two of the referrals that we have: U Direct IRA Services in Southern California, and
Right.
of course M Trust. Which one have you used? Did you use?
I actually used the interest group. I don't think I was aware of UDirect, but actually UDirect is actually closer logistically to where we live. But we did end up using interest, and they're actually, I have no regrets with interest.
Yeah,
They are efficient. They are on it. The fact that we're in Southern California, they're in Northern California, it really made no difference because we were doing everything online anyway.
yeah. Anyway, okay, so we're not gonna go over technicalities.
But wait, there's more.
Yeah, there's more. At the end of the day, income property, the returns are not subject to Wall Street or SEC or NASD, National Association of Security Dealers, or SEC, Securities and Exchange Commission, and all the very heavy compliance restrictions that you get with the mutual funds, right? So,
Right.
yes, so therefore, you have more control. You have more control having that income property inside the IRA because you can dictate where the money is going, what property to buy, what kind of tenant you can get. But anyway,
Right.
of course, we're not going to go over this. Of course, you have to find the right property, the right market. And I'm not going to go over all these economic drivers where that fourplex is located. It takes one more hour to discuss all the drivers in that location. So,
Exactly.
yeah,
Right.
suffice to say, if you buy a property that are fast growing, a lot of growth, they have the new hospitals, new medical industry are there, a lot of colleges and universities located close by. These are very important economic drivers. Yeah. And they have an element of high tech in South Texas, which is this property is located by the network water South Texas is
Right.
the fastest growing county in Texas for that matter. So they have all these kind of great high tech emerging industries in that location give you a lot of growth and a lot of population growth, job growth and everything else. Again, this is the area. McAllen, Edinburgh is the fifth largest county in Texas. So which is right. Okay, I'm gonna bypass. Is located in Hidalgo County for those of you. It's up and coming boomtown, if you will. Again, I'm gonna quickly go over this so you can people can study or further beyond this presentation. So, all right, and of course, Elon Musk and X they have a launching pad rocket center close by. Starbase Gaming. So they have a lot of employees, a lot of companies are moving there to support SpaceX. So that's another economic drivers that will really help this market region. Okay. So anyway, again, final thought is income property truly outperform the stock market in a way that we talked about. And of course, our business model when we promote this kind of property is you buy long distance, you buy remote, you buy touring construction, cash flow rentals. What I mean by that? Of course, you buy in a particular market, and you and I know we have done it. Okay, I have consulted my investors for more than 20 years to buy out of state, buy in a good market, and surround yourself with a great team. What the great team means, you have the property manager that will do all the work for you. You have the inner circle, the support circle, the service circle, the whole one umbrella of people helping you.
Right.
Your investment. So you can pretty much, I can safely say that even though you buying a income property, it's almost passive. It's just like mutual funds. Mutual fund is totally passive, right?
Yes, absolutely.
The concept that we talked about, buying remotely, buying out of state, buying turnkey, having a great team of people surrounding you is almost 100% passive.
Right. That's true.
So,
That's very true.
yeah, for a retiree, whether you're age 60, age 65, age 70, you don't need to worry about the maintenance issue, using the hammer, try to fix your house or try to evict the tenant or try to do all those labor. You don't do any of that.
Nope.
Okay. You're retired. You can draw on your income from your income property 40% higher than the traditional withdrawal, 5% through Wall Street, and still have the same quality of lifestyle, totally prioritizing. You can still do whatever you want every time and travel around the world or spend time with the loved ones, become a digital nomad, knowing that these two fourplex will trigger more than $6,000 of monthly net income. Okay.
Right.
So you can continue to live above the quality based on the traditional $1 million do the IRAs.
Okay.
And just to accumulate what we said, Julie, you have 6 rental properties. You bought turnkey 2,000 miles away in Buffalo. Right. Same concept we produce, property management, do everything for you. You bought remote, sight unseen, turnkey 3.5 years ago, 6 rental properties, several of them through using your IRA. Right. using regular conventional financing, 25% down, husband use your name to finance conventional 25% down. And of course you put totally 100% down.
Right.
And guess how many hours you spent on to managing your 6 rental property portfolio?
I would say mine's closer to the 1 hour. You put 1 to 2 hours, mine's closer to the 1 hour. Yeah, only a month. I think people need to understand that. It's a month. Like basically all I'm doing is logging information into a software program that you talked about, the property tracker. And I do that once a month. It's easy peasy.
What more can I say? Coming from a horse's mouth, you're getting a real life example. And not just you, right? A number of my investors
Oh yeah.
that I helped over the years have gone through similar situation what you're going through. And,
Right.
and our presentation is real. The strategies we present on these podcasts is real case example of my other investors that I've helped over the years do the same things. Yep. And okay, one more sub module we could spend about maybe 5 or 7 more minutes. Gonna maybe people do option 3. The option 3 is, let's say you guys out there, you're not age 60. You are not about to retirement. You are maybe your age 40, age 35, age 50. You're 15 to 20 years away from retirement. And let's say that we're going to use a scenario, same thing, where you already have $1 million saved up under your qualified plan, the IRA, IRA, traditional 401k from various tax qualified retirement plan bucket. Okay. You're 10 to 20 years away from traditional retirement. What should you do? What should you do with those traditional portfolio? Here it is, Julie. You know what I'm talking about, but the audience need to understand this is a very practical option 3 strategy. You could still use the self-directed IRA. You may not want to transfer all of your $1 million all in one fell swoop. You could for a certain percentage of your existing traditional IRA that you accumulated over the years. But you are a millennial right now. You are a Gen X, age 40 to now age 50. This way you can leverage if you use the word leverage, that'll give you a much higher return because you're using some of your money to buy a underlying asset, right? Using the leverage with a self-directed IRA with a non-recourse loan is the same concept. What I mean by that? Okay, let's discuss that. Using the same property, same purchase price. This time, you're not putting in $539,000 on your IRA full cash purchase, right? You're putting 40% down. 40% on your IRA, 40% multiplied the property. This property is $227,000. Okay, so for good.
Makes sense.
So you're only putting 40% of your IRA money. You're getting a non-recourse loan. Although, the rate is higher, 8.5%, even 9%, but you're using leverage. You're using the power of OPM. OPM is other people's money.
There you go.
So therefore, if you can leverage, I will talk to you about the non-recourse lender momentarily. By using the power of leverage, your total return of investment is 16% because you're not using all your money. Because you're using a 6% loan to value. This is the underwriting requirements for this particular non-recourse lender. Some people ask me, Julie, what do I mean by non-recourse loan? Would you care to answer what I mean by non-recourse loan?
That's actually a specific type of loan that is used inside of the self-directed IRA. It does require a little bit higher down payment than maybe a traditional IRA where you can get in with even as a homeowner 5 or 10%. But it does require more, but then it is again its own inside of the IRA. There's no ramifications against the owner of the property in terms of a default or anything with the loan. So it does give you an opportunity to leverage the assets that you have inside your IRA to be able to buy more property.
Okay, to your point, very good, correct answer. To your point, by any slight possibility, you can, if you default on a non-recourse loan, the non-recourse lender can only go after your underlying asset, which the property inside the IRA. They cannot. There's an important distinction. I'm going to say one more thing important. They cannot come after your personal asset.
Yes.
Very reassuring. That'll give you a comfort level to do this. And with the risk is so low. If you buy a property, 40% down IRA and 60% loan to value, non-recourse loan, if you buy very good market, a growth market, when there's a good rental market, you get a lot of rent and, population growth, job growth and everything else long term, the chance of default is very slim to none.
Correct. Yes.
Yeah. So we're using the mercy of the because the non-recourse loan, which is 60% of the value of the house, is $323,000. So at 8.5%, maybe even 9%, different kind of loan program. We cannot not enough time to discuss the different loan program we have. But the non-recourse loan monthly amount is almost $2,500. But you collect the rent of $5,200. Okay. You pay 40% down, $227. Okay. Right. So this $2,489 non-recourse loan monthly is subtracted from your gross monthly income, the 4 units from the 4 doors, then your minus property taxes monthly, as you can see right here, and your net monthly cash flow. If I can show this better. So your net monthly cash flow is only $630, not $31. You're thinking, oh, my monthly cash flow is too low because you have to pay the non-recourse monthly amount. That's not the point. The point is you're not ready to retire yet.
That's a very good point. Yeah, because you said if they're in their 30s or 40s, so they still have a number of years before they're going to retire. By the time they retire, the loan will be close to paid off, if not paid off, and then they'll have the full benefit of the rental income when they need it, once they retire.
You just took the words out of my mouth. I don't have to explain any further. Okay.
And you'd have a paid off property.
Yeah, with half the money, with less than half the money down payment with the IRA.
Exactly.
Purchase.
Exactly.
I think the audience out there, you should begin to know what we are saying.
You should be getting excited, especially if you're in your earlier years and you still have a number of years to work.
No doubt about it. You should be getting excited because the information you and I are sharing, that very few people know about these kind of strategies. In fact, Julie, you and I understand, okay? Even though you are a newbie, you only bought your 6 rental property portfolio like 3.5 years ago. Prior to 3.5 years ago, you own no rental properties all through your adult life.
0.
But did you not learn so much in the past?
Oh, learned so much. And it was so worth it too. It was so worth it. Like I said, we're not using the money right now that's coming from the IRA. So it's just going back into the IRA and building up the IRA for at some point when we'll need it. So we're just stacking cash to use kind of a street term, stacking cash.
Yeah. By tax deferring growth from the income property cash flow, you are stacking up. You're rolling the IRA back, the cash flow back inside the IRA because you're not ready to retire yet. Anyway, a lot of people, a lot of CPAs, a lot of attorneys, a lot of financial planners, they don't tell you this kind of information that we have. They don't know. They don't know these kind of strategies. They are clueless.
No, you're right. I agree with that.
Wow. Do you not?
It's not a new concept. Because, when you first told me about it, I did my homework. It's not a new concept. I think a lot of people haven't heard about a self-directed IRA and being able to use that to purchase property, but it's a concept that's been around for a lot of years.
Oh, yeah. As a matter of fact, I'll tell you exactly how many years. The ERISA Act, ERISA Act, was implemented by the IRS in 1973. So we're talking about these type of strategies that existed for 50-something years. This buying alternative assets inside the IRA, other than mutual funds. It's been available. It's just that the mainstream media, the stock market, they are keeping people like clueless. It's a conspiracy.
keeping them dependent on the brokers that are getting paid to not do what they're being paid to do.
Yeah, this is a non-recourse lender. This is, of course, you can read about it. This is the underwriting requirement for a non-recourse lender, and this is their rule, right? If you want to do a non-recourse loan, you could use this non-recourse lender. And in my estimation, this is the only non-recourse lender in a country that does these kind of things, and they've been doing this for decades. Okay, this non-recourse lender, and you have to succumb to their underwriting requirement, which is if you're going to buy income property 1 to 4 unit, the maximum LTV, maximum loan to value, 60%. So you have to put 40% down payment, and it will leverage the other 60% on the behalf of the IRA. And okay, anyway, if you guys need to want to contact me, what's the name of the company? I think is American Savings Bank. I'm not sure, but anyway, I've been using their lending for a number of years. So at the end of the day, Julie, would someone buy a self-directed IRA with or without a non-recourse loan? It doesn't matter. You're buying in the name of the IRA, and you as an individual, you don't have to submit FICO score. You don't have to.
Right. That's fine.
Yeah, the IRA is doing everything, even with the non-recourse loan. So you don't need to submit your loan application under your name. You don't need a FICO score. IRA is doing all the qualifying, the underlying. At the end of the day, when you file your federal tax return every year, as long as you do not out, not reportable, federal tax return. He's right.
Yes, that's right. That's right. Just like any other IRA, you don't report anything until you begin to withdraw funds out. Yeah, it's just, and that's a good point, because I think people get a little confused on that. It operates just like your traditional IRA. All the growth in the property, appreciation of the property, the income is not taxed until you take it out.
Yeah, not only that, Julie, and this non-recourse loan is not a regular loan. It's a private loan. It's a portfolio loan, and does not count against the number of loans you need under the Fannie Mae lending guideline.
That's right, because it's in the name of the IRA.
Yeah, it's because the non-recourse loan is leveraged to the IRA, so it's not visible. It's
count against your personal name.
Yeah,
or not the individual. Yeah.
Fannie Mae lending guideline, you can get up to 10 loans to buy income property at 25% down payment, whatever.
Exactly.
But these 10 loans does not care about the non-recourse loan. The non-recourse loan is invisible. It's not cut for your personal lending criteria.
Correct.
Yeah. A lot of people don't know that. Anyway, I think
another benefit of putting an asset inside of your IRA.
Right. Exactly. Yeah. So in conclusion, to recap, we have given you some amazing information that you guys listening right now, you would otherwise not having the resource, the means to learn. We provide the technical, the theoretical, the apple-to-apple comparison. When you retire, should you use the traditional IRA format to draw the money, which is very limited of what we discussed, or use alternative asset inside your IRA to get higher return, higher withdrawal rate, increasing rental income, retirement through the income property we just discussed. What else can we provide you, right?
It's a win. There's no downside. There really is no downside.
Okay, with that said, as we conclude, if you receive any value whatsoever from this podcast, please like and subscribe to my YouTube channel. And also comment below what do you think about this strategy. And also if you have not already done so, put your email into our website below so you can become our investor insider. You can become a free member of our network. When you log in your email into my newsletter database, then you every morning, mostly you will receive ongoing great free education around real estate investing. So thank you so much, everyone.